Hi, and welcome back to Hedge Fund Manager. I'm Karl-Mikael Syding. So let's conclude this deep dive of Microsoft. We are at the CAGR stage, and we need a starting point for our valuation of Microsoft. And in this case, I've chosen EPS, earnings per share. It's a very good place to start. You could have used revenues, for example, as your valuation base, or book equity, but that typically depends on what type of company you are investigating. In this case, it's a typical company with operations where they manufacture something, in this case usually mostly software and also some hardware appliances. They sell it for an income, and this income you divide or distribute over the total number of shares for an earnings per share or a cash flow per share. You could actually remember and make a note that what we typically are really after is the free cash flow, the sustainable, normalized free cash flow. That is how we actually make a fundamental valuation of a company. But it's a very good shortcut, and you will still be way ahead of most of the market if you focus on normalized earnings per share. It's good enough, and price earnings ratios in the case when debts are just a marginal debt or net cash, as we could see in Microsoft's balance sheet. So let's look at the earnings per share for Microsoft as the starting point. So this is the quarterly earnings per share trend. I've used quarterly because I want to make sure that there's nothing suddenly happening in the last couple of quarters. If so, then maybe I will discard this company for now, or I would bring up their quarterly report and actually read what they are talking about, why things are suddenly changing. Actually, you should do that every time before investing, actually putting your money at risk in any company. Anyway, here you have the current trend for quarterly diluted EPS, and let's check in Koifin what their annual earnings per share is. And you can see the trend here. It's been growing steadily, mostly steadily, most of the years. Up until here, we see 11.8 for their last fiscal year. And if we look at in the actual table here, we can see that 11.80, that was the last fiscal year, and the last actually 12 months or 4 quarters reported level, including the last few quarters, they are at a 12.94 EPS level. And so that is what we will use as our basis for our forecasts for the coming 4 years EPS level and the coming 4-year endpoint valuation multiple estimate. So remember 12.94 as the earnings per share starting point for our CAGR calculation. Make sure you make notes of this when you are doing this yourself for a company, so you very quickly can see, so what was my actual basis for my analysis and my investment and my estimate of future prices and EPS levels. So this is the starting point. The last 12 months LTM EPS 12.94. Then remember, in the P equals F times V calculation, we start with the F, the fundamental. So we have the 12.94, and we also recall that we estimated EPS growth at about 17% per year. Over 4 years, I've used the notation here with brackets, 17% G, 4 years, that comes to 24.24 EPS. This is a very easy way to calculate it. You enter 12.94 here in TradeBrains. For example, you can use any DCF calculator, enter number of shares as just 1, so this is 12.94 EPS per share. it doesn't matter that it says free cash flow. This is just a calculator. You're calculating whatever you put in here and how it grows at a certain rate over a certain number of years. You put in the expected growth rate at 8 here. And now let's see what this comes to, because you have all the calculations here. So the first year, 12.94 grows to 13.98, and over 4 years it grows to 17.61 earnings per share. Wait, what's this? There's something went wrong here. 12.94, total number of shares, expected growth rate. Oh, 8%. That should be 17%. So good catch there. And now we get at 4 years to 24.24. That's why it's pretty good to actually use a calculator rather than estimating things or being sloppy when checking up on things. Then we get to the valuation. I use this notation again, price earnings ratio 4 years into the future, looking back last 12 months. I estimate a reasonable level at about 25 to 30 times. That would mean a price earnings growth rate of, let's call it 2 times, but that is forward looking. So at 25 times PE or 2 times PEG, that would be estimating a future growth rate of 12.5% or maybe 15%. So what I'm estimating here implicitly is that the growth rate will be 17% up until the 4-year mark. And after that, it falls to maybe 12.5 to 15% per year. And the market would value that forecast at about a PEG 2. So slightly lower than today's 2.35 PEG ratio. Exactly how you go from a growth rate to a warranted price earnings multiple or price sales multiple, we've seen in a lot of other videos. And what you can do is simply you use a DCF calculator like TradeBrains, and you play around with various growth rates. For example, put in 15% and a discount rate of 15%, a last free cash flow multiple at the terminal value, etc., etc. And then it will calculate an intrinsic value per share based on these estimates. And that intrinsic value per share you can divide by the first profit or the most recent profit, and that is the warranted multiple given a set of assumptions at a certain point in time. But I've explained that several times before. So we now use our estimates here for price earnings ratio and the EPS, the future EPS. 25 to 30 times 24.24 comes to $606 to $727 per share. Today's share price for Microsoft is 436. You can see here that it just recently fell to 433, actually, but we'll use 436. And the dividend yield is 0.8%. You can actually also see that here very easily in investing.com. You have a dividend yield of 0.8%, or actually $3.30 per share. So it's almost negligible. Just using these numbers, 606 over 436, or 727 over 436 over 4 years, that comes to 8.6% per year or 13.6% per year. Just use a calculator for this. Add the dividend, and we get to these total return numbers. Below 10%, that's really poor. Still below 15%, well, it's decent, but it's not good enough to warrant an investment in just a single stock. But let's include that in the concluding risk assessment section of this deep dive of Microsoft.